Hey everyone, today I'm diving into IFRS 15, Revenue from Contracts with Customers. If you're a finance student, this one's for you. Grab a coffee, sit back, and let's get into it. Alright, so IFRS 15 is all about how companies should recognize revenue. It was introduced to bring consistency and comparability across financial statements. The goal is to make sure that revenue is recognized in a way that reflects the transfer of goods or services to customers at an amount that the company expects to be entitled to. First, let's talk about the core principle. IFRS 15 uses a 5-step model to determine how and when to recognize revenue. Step 1. Identify the contract with a customer. This is any agreement between two or more parties that creates enforceable rights and obligations. For example, if Company A signs a contract to sell 1,000 widgets to Company B, that's a contract. Step 2. Identify the performance obligations in the contract. These are the distinct goods or services that the company promises to transfer. In our example, the performance obligation is the delivery of 1,000 widgets. Step 3. Determine the transaction price. This is the amount that the company expects to be entitled to in exchange for transferring the goods or services. So, if Company B agrees to pay $10 per widget, the transaction price is $10,000. Step 4. Allocate the transaction price to the performance obligations. If there's only one performance obligation, this step is straightforward. But if there are multiple obligations, the transaction price needs to be allocated based on the relative standalone selling prices of each distinct good or service. Finally, step 5. Recognize revenue when the entity satisfies a performance obligation. This happens when the control of the good or service is transferred to the customer. In our example, revenue is recognized when Company A delivers the 1,000 widgets to Company B. Now let's look at a real-world example. Imagine a software company that sells a subscription service. They sign a contract with a customer for a year-long subscription. The performance obligation is the continuous delivery of the service over the year. The transaction price is the total subscription fee. Revenue is recognized over time as the service is delivered, not all at once at the beginning of the contract. IFRS 15 requires a lot of judgment and estimates, especially when it comes to variable consideration, significant financing components, and non-cash consideration. It's crucial to understand the specifics and nuances to apply it correctly. If you found this breakdown helpful, make sure to like, comment, and subscribe for more finance insights. Thanks for watching and see you in the next video.